This is going to be part 2 of how firms are organized from a legal perspective. We're going to mostly talk about corporations. If you were following with the previous part of this presentation, we were talking about the different types of organizational structures that you can actually have in firms. We were talking about sole proprietorships and partnerships. Now we're going to talk about corporations. Now, corporations, unlike the other two, are a unique legal entity that are actually created by the state. And here is the important part. They're an entity whose assets and liabilities are separate from the owners. And this aspect is what makes corporations so unique and probably attractive from a business perspective. Okay, what does this mean? This means that they are their own legal entity when it comes down to their assets and liabilities. So what that means is that we can finally separate the ownership of the firm, in this case of the corporation, and the liability. So what this enables to do is it enables the firm to acquire more capital and more assets. So let's see how this works. Essentially, the firm it's going to have its own legal status. So this means that the firm itself, the corporation, is going to be able to own property. So there's going to be, for example, land, machinery, and maybe other types of assets like brands or maybe patents that are owned by the corporation itself. Okay, and the corporation can also transfer property, so it can buy and sell things. Okay, the corporation itself can enter into contracts. So the corporation can hire people, right? And also, if there is a situation where there is a negative impact, the corporation can be sued, and the corporation, if it feels like it's been damaged in some way by somebody or another corporation, it can actually sue the other corporation or that other individual. Okay? So this separation of assets and liabilities from ownership is the crucial differentiation between corporation and the other two types of entities. Now, because they are separate, the owners are going to have a way of owning part of the firm, and the way we do that for the most part is using stock. Stock is essentially a little piece of paper that says that you own a percentage or a part of that corporation. Okay. We're going to talk about the different types of stock in a minute, okay? And after you own that stock, you're going to have three things that come with that. One is the price of that stock could go up if people perceive that in the marketplace that corporation is doing a good job, and because of that, maybe they should be worth more money than what they were worth before. So that's your stock price going up. Also, you might be getting some dividends from that stock. So what are dividends? Dividends are profits that are shared with the owners of the corporation. So the corporation is going to decide what portion of the dividends that they actually, profits that they actually earn. By the way, profits are the difference between revenue and cost, right? So any money that you are making above and beyond your cost, the corporation is going to decide whether it goes back to the owners or it gets reinvested into the firm. If it goes back to the owners, it will go in the form of dividends. Okay. By the way, not every stock pays dividends. So, and then lastly, with owning a stock, at least some types of stock, like we will see later, you will have the right to vote in basically making major decisions for the corporation. Okay, so those are the three things that you get by owning a stock for the most part. Now, how do you create a corporation? Well, like I said before, they are created by the state. So each state in the United States has their own process, but they are all fairly similar. Okay, the people that want to start the corporation, they are called the incorporators. And what they are going to do is they're going to try to create this new firm, this corporation, okay? And the way they do that is they'll go to the state, so you'll have to go to your local state government, okay? And you're going to start a procedure that is called the chartering of a corporation. Okay. Like I said before, for a sole proprietorship, maybe you don't need a lawyer. I will argue for a corporation, to make sure that you're doing things right, you might want to involve a lawyer into this process. Okay. These incorporators will file the articles of incorporation. Okay. Again, this is a process that happens with the state. You'll have to fill up some forms and pay some money. Okay. And this will be more forms and more money than with the other two types of companies that we have discussed, because it is a more complex scenario, and also because you're going to create a new entity that has both legal and tax purposes their own identity, right? And the way you do that is by filing the articles of incorporation. Okay. And then the state, after you file this paperwork, is going to issue a corporate charter, which is basically like a birth certificate of the corporation or the company. Okay. And from that moment on, the corporation is going to be functioning as its own entity, and it can do all the things that we were talking in the previous slide. Okay. Now, at the same time, once that the corporate charter has been issued, the owners of the corporation are going to establish the bylaws, which are the rules that are going to be followed to govern the corporation. And to that effect, they are going to elect a board of directors. These are going to be the people that are going to make sure that the corporation is fulfilling their long-term goals. We'll discuss them a little bit in more detail in the following slides. Now, what kinds of corporations there are? There are many. But like I mentioned before, because they are created by a state, so if you are here in Virginia, Virginia has their own legislation that deals with corporations, and if you want to start a corporation in Virginia, it will be done locally at the state of Virginia. This is not something that happens at the US level per se. Okay, so a domestic corporation, for example, in this situation, will be a corporation that only operates in the state of Virginia. Okay, that will be domestic. Okay, now this word is used a little bit differently than it is maybe in the news, so you need to watch out for this. A foreign corporation, this is where it can get a little bit confusing, is one that operates outside of the state in which it was actually chartered, but not necessarily outside of the country. So for example, if you're chartered in Virginia and you operate in North Carolina, for example, in North Carolina you will be considered a foreign corporation. Okay. And finally, an alien corporation is a corporation that operates outside of the nation in which it was incorporated, which in this case is in the United States, right? So if you start selling something in Canada, for example, and you were chartered in Virginia, now you are considered an alien corporation. Now, other differentiation about different types of corporations is whether the corporation is private or public. Now, what is a private corporation? It's a corporation that is owned by a small group of people, okay? Usually family, but it doesn't have to necessarily be. So you will see oftentimes private corporations are actually owned by a group of family members, okay? But the important part is that if it's private, stock cannot be sold to the public. So you or I, unless we have some sort of special relationship with the people that own that corporation, we have no way of acquiring stock, even if we wish to do so. Okay, so the public at large cannot own stock in this private corporation. Okay, now the nice thing about having a private corporation, although they have a limitation in the amount of capital that they can acquire, because not everybody can buy stock, that's a limitation. But the nice thing is that they do not need to disclose their financial information publicly. That doesn't mean they don't need to prepare financial statements. Of course they do, because they need to file those with the IRS for tax purposes, but those are not public. Okay, and because of that, they are not disclosed to everybody else, and they don't need to tell the public how the company is doing and or what are they thinking they're going to be doing in the future. So from a strategy perspective, this is an advantage. Okay. And finally, you can go from having a private corporation to make it public by having an initial public offering. This is when you open the possibility from people outside of this small group of people that already own the firm to buy it, and this is called an IPO. You might hear this in the news. Hopefully you'll follow the news so you know what's going on. Okay, so that's what an IPO means, is when a company that was private tries to go public by offering their stock to the general public, and then people might be able to, well, will be able to buy some of that stock. Okay. Here you have a few examples so that you can see some companies that you know are actually private. And you may or may not Cargill, hope you do, or Cog Industries. If you don't, one that for sure you will know is Albertsons, right? It's one of the largest supermarket chains in the US, and it is a private company. But look at the sizes of these private companies so that you have an idea, right? So these are revenues. This is the amount of people the amount of money that they sell of whatever products they're selling every year, right? So this was in 2018. Okay. So about $110 billion in revenue. And this is number of employees. You can see the largest one has over 250,000 employees. That will be Albertsons, right? Okay. Anyway, just so that you guys can have an idea, you can also see some consulting firms here, maybe some more supermarkets, candy, etc. Okay. Now, public corporations, like I was saying before, the characteristic that they have is that anybody can buy and sell their stock. Okay, stock is usually in public corporations traded in some stock exchange. Maybe you've heard about the New York Stock Exchange, but there are others, right? And if you want to buy a stock, you can contract your broker, and if it's a public organization, you should be able to buy it at whatever price is selling in that particular time in the marketplace, right? So the nice thing about this is that this opens up the capital market for you, and that means that if you need more capital, you might be able to get it because you can sell more stock, right? Because everybody could buy it, right? Again, you can take a public company private, and this has happened many times. Let me tell you of a company that maybe you know, Dell, which is a company that sells computers. I'm assuming you know who Dell is, but Michael Dell is the founder of the company. And Dell was a private company that became public, I think, in the 90s. And it did very well for a few years and then started to struggle. And Michael Dell, the founder, bought the majority of the stock and took it private. And now Dell operates as a private company. And there are a couple other types of corporations. In fact, there are many subdivisions of type of corporations that you might hear about. One is quasi-public. This is basically where the government establishes a corporation for a particular charter. An example of this will be NASA. I think you guys know what they do. So. And then another thing that we have briefly talked about is nonprofits, right? These can also be corporations, and even though they are non-for-profit. And an example of this, for example, would be the Red Cross. Now, here you have a table that kind of summarizes the different types of corporations and what characteristics they have, and when will you use them and when you won't, right? There are a couple here we haven't discussed yet, but we'll talk about them anyway, right? So you have sole proprietorship, one owner, like we said, very common. What is the taxation here? The owner pays all the taxes, which could be good or could be bad, depends on the amount of profit you're making. Okay, it's income, it's taxed as an income, right? The difficulty with this is that you have unlimited liability as the owner, so anything goes wrong, all your assets are at stake, not only the ones that the company owns or you invested in the company, right? Use, 1,000 uses, right? But a lot of small companies start like this, right? Partnership, we already talked about it, at least 2, maybe thousands in the case of large companies like Ernst & Young, for example. Okay. What is the taxation? The owners are taxed as individuals, so it's taxed as an income. Depending on the type of partnership, some of the owners might not be liable fully, Okay, but there is always at least one, and oftentimes many partners, if there are large number of partners, that are fully liable with all their assets. Okay. Okay. And then we have the corporation, which is what we're just talking about right now. The nice thing of a corporation is that it separates the ownership from the liability. So the corporation is its own legal entity. And depending on the type of corporation that you're talking about, a C corporation, for example, you can have any number of shareholders, okay, which opens up large amount of capital options. That's good if you need resources. Okay. The taxes, they are paired separately from ownership and profits. So profits, you will just pay taxes as a corporation. Okay, and the shareholders will pay taxes on the dividends. So what's going to happen is you're going to get double taxed. Okay, so you're going to get taxed on the profits because you're a corporation, and then those profits, if they are divided among the owners, are going to get taxed as income. This is the double taxation problem that corporations have. Okay, which is a little bit of a challenge. The government doesn't mind though. The government always happy to take more of your money, right? Whether they earn it or not. Good. But here is the cool thing, and this is the most important aspect I will claim of corporations, is that they have limited liability. What does this mean? Well, the corporation can go bankrupt. You can sue the corporation and take all their assets, but the owners will be separated from that lawsuit. So that means that the owners can put money into the investment of a corporation without being fully liable for what happens in the future. So that's going to make you more willing to put money into it because you know that they are not going to take your house, right? They'll take whatever you put in there. So if you put $100,000, that's what you can lose, right? And like I said, they are their own legal entity, all right? So this enables the organization to do all sort of things and operate independently, especially, and big access to market capital. Most large organizations in the United States, although there are exceptions, like we have talked about, are corporations. Okay, I've shown you some of the partnerships, like some of the large consulting firms or accounting firms. Okay. S corporations, it's small section of a corporation that are a little bit different. It limits the total number of shareholders to 100. Okay. Other than that, everything else is essentially the same. Okay. Except that they are taxed a little bit differently, like a partnership, right? So this avoids the double taxation problem. Okay. But they are doing so because they limit the amount of access you have to market capital. Okay, so this is a special type of corporation that tries to kind of has the best of both worlds. If you're trying to really go for large capital markets, this is probably not a good idea. Okay, but from a tax purposes, it might be more attractive. Okay, and then there's limited liability companies, and where you have a limited number of shareholders, but they are still taxed as a partnership. Okay, so this could actually be an attractive option under some conditions. Good. What have we not talked about? We haven't described very well how the governance of the organization functions. So once that you have a corporation, who's going to make the decisions about what's going to happen, for example, with the profits? And the answer is the board of directors. Now, who are the board of directors? They are going to be usually professionals that, in theory at least, they're experts in the field, right? So you might have some people that do finance in there. You might have some people that do marketing. You might have some people in there that do management, right? So they can actually know about the kind of activities that happen within the organization. Hopefully, they're experts in the particular industry or industries where the corporation operates. And the interesting thing is these people are elected by the stockholders, right? So if you own stock in the company, you might be able to vote and decide who's going to be part of the board of directors. I will come with no surprise that oftentimes the board of directors is formed by people that actually own a large share of the stock. And the reason why they are there is because they essentially vote themselves in, right? So if you own 10% of a large corporation, you can put yourself into the board of directors because you control 10% of the vote, right? Anyway. And what the board of directors does is it sets the long-term strategy for the organization. What markets are you going to be operating in? What large projects are you going to be investing in, etc., etc. Also, they act as a controlling mechanism to make sure that whatever objectives have been set, they are actually fulfilled. So they look at the numbers at the end of every quarter or at the end of every year, probably both, and they will just see, hey, are we on track to achieve those goals that we have set or not? And if they're not, they might fire some of the people that are directors under their wing. For example, they choose who the CEO or chief executive officer is, the board of directors chooses, right? So because of that, if they think that their objectives that have been set forth are actually not being fulfilled, they have the right to fire management, right? The people that are looking at the day-by-day operations and making the decisions to try to achieve these goals that the board of directors have set. Okay. Now at the stock, like I said before, there are two different types at least of stock. There is preferred stock. This is stock that has first dibs when it comes down to profits. So if the organization decides that it's going to set aside $1 million of the profits for dividends, people that have preferred stock will have first dibs into getting that money, okay, which will be divided according to some rules established in the bylaws of the firm, okay. On the other hand, common stock is stock that don't have first dibs at profits, but have a chance to vote and elect people to the board of directors. Okay, they can vote by proxy. What is by proxy? Well, they elect people on the board of directors, and then the people of the board of directors are the ones that make the decisions. Okay, but the way they get compensated is through the voting instead of through the dividends. Okay, and so it depends what it is that you're trying to achieve. Are you trying to control the firm, or are you trying to, in the direction of the firm, or are you trying to make some money and you really don't have grandiose aspirations of deciding what the firm is going to be doing or not? Okay, and then you'll use one or the other. What are the reasons why you create a corporation? I think I've already established this, but let me reiterate it. Okay, the biggest advantage is that it separates the liability from the owners. So that means that if you invest $1 million into a firm, you can only lose $1 million. Okay, they cannot take your home, they cannot take your villa in some remote location. They can't take any of your assets except the ones you have invested into that corporation. So this opens up a lot of options because the risk of investing this way is a lot smaller. You can lose all the money you invest, but you cannot lose your house. That's a big plus, right? And this is why a lot of people own stock, right? Because you play this limited liability game, okay? And another nice thing is that it's an entity on its own, right? So legally, it's its own thing. And it's separate from the owners, which means that it has perpetual life, unless it goes bankrupt, right? And unless it gets dissolved because there is no point in continuing forward, there is no problem of continuation. Unlike in a sole proprietorship, where sometimes when the proprietor either gets tired or decides to quit or dies, then the company stops, right? Unless somebody else can take over the reins, right? But that's not a guarantee, okay? And the biggest advantage other than that, the liability that we talked about, is that you have access to a large amount of external funds. Okay, good. Downsides, already talked about them. Double taxation. You get taxed as a corporation first, okay, and then after that, 35%. And then after that, on any profits. If you give money back to your owners via dividends, they are going to get taxed on that too as an income, right? So all the money you're making gets taxed twice. Uncle Sam's happy, right? Another challenge or difficulty is that it's not nearly as easy to set up as it was in the case of a sole proprietorship. And another downside is you need to disclose your financial statements to your investors. So that means everybody knows what you're up to, okay, at least to some degree, right? And because of this, maybe you're at a little bit of a strategic disadvantage when it comes down to what it is that you're doing strategically, right? Because people might have already a guess on what areas are you working on, what new products are you developing, etc. Okay. And then making decisions might be challenging because the owners and employees are separated, right? So now you're starting to make decisions by committee. Not unlike in a sole proprietorship where you are the only captain, you make a call, it happens right away.